Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenburg from Whittenburg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
Welcome to the Wealth of Insight podcast. I'm your host, Austyn Whittenburg, and today we've got Nikko Denis with us. Nikko is a branch manager with Intercap Lending in the mortgage space, and he, someone that I've worked with for, probably 5 or 6 years, wouldn't you say now, Nikko?
Yeah, it seems like we've known each other for longer, but it's been a joy so far.
Well, I appreciate you joining us today.
Thanks for having me.
And so we did an episode, this was probably 6 or 7 months ago now, on mortgages. And I know that, so that's what we want to talk about again today, because so much has changed over the last 6 or 7 months. It feels like, as I've been working with clients, for the last decade, everybody's been refinancing. Rates have just been low. It's been buy whatever you want because money's free. And then all of a sudden that changed drastically in the last 6 months. So can you just give us sort of from your perspective, doing this day to day, what that ride has been like, and just sort of give us a history of where we started maybe this year and where we're at now?
Yeah, sure. It has been a wild ride this year. Rates at the beginning of the year started out very favorably. It really wasn't until March or April that we started to see rates start to climb up. That was when the Fed first, tried to get a handle on this whole inflation thing. I'm not sure if you've heard about what's going on, Austyn.
Yeah, need a little bit of news, right?
That was sort of the tipping point. I would say April is when we started to see a big shift, in our market, and when we first started to see, interest rates come up from where we were spoiled, over 2020 and 2021. Today it's, middle of December 22, and rates have peaked and are starting to settle into what I'm going to call a more normal range. But for some context, at the beginning of this year, we were closing loans at 3%. And, today we're closer to about 6.5%.
And my dad every time we talk about it, he tells me just to quit whining, because he remembers back in the 80s, him buying his first house. And he always says it was 18% and it was reverse amortizing, meaning he owed more money the second year than he did the first year. But with rates that high, that was just what you did. So
that was life.
Yeah. Historically speaking, that maybe, 7 felt like it was high. 6 definitely still feels high compared, for a lot of at least people, millennials, so to speak, who we all got our first homes in the 3s and 4s, but really it's maybe more just the dramatic increase, doubling overnight, basically. That's been, I think, the biggest shock, because the reality of it is that 5 to 6 range probably is a realistic long-term average. I don't know if you have data on what the long-term average is, but that feels like a pretty good place to settle.
Yeah, if we're looking at long-term averages, you're right. 5 to 6 is considered normal. But the hard part is we all got so spoiled. We got so spoiled over the last couple of years that now we've got these unrealistic expectations as to what interest rates should be. But so many people struggled to find a home and to find housing because of the competitive rate environment, and because of this sort of problem that was created because rates were taken to such a low level. So, now it's the conversation has changed a little bit as far as housing and what should we do with rates being this high. And, I like to say the same thing your dad said. Well, rates aren't really high. It's just that you were really spoiled the last couple of years, and now we're settling into a normal range. And you're right. 7 is not normal. It's, it's on the higher end, but I think we're making a return back to normal.
So if we're heading back to normal, I guess that leads into, when do we think we get to normal? So, as I think about, I think now, so I don't deal, obviously with mortgages. That's why we have relationships with individuals like yourself, but we have, I do a lot in the bond and fixed income space, and there's definitely a correlation between the two, right? 2022 has been one of, if not the worst years for bonds in the history of bonds. That's maybe, I'd have to go check the data on the full history, but the Barclays aggregate index, which is just sort of a broad paintbrush of, where bonds are, has had a really challenging year because of how quickly rates went up, and I'm not expecting them to come down near as quickly. So as you're reading and listening to people in the mortgage space think about, and talk about what 2023 may bring, where do you see things heading from here?
Yeah, I think we've got a little bit more pain ahead of us. I don't know that the Fed quite has a control on inflation. They may seem to think. We've seen some positive news. November was the first time we saw inflation numbers come in lower than projected, and we saw both the stock markets and the bond markets rally. So what that tells me is the market is primed. The market is waiting for positive news of inflation, or rather negative news of inflation, right? I think that truthfully, as long as the Fed can get a handle on inflation, we will see mortgage rates, continue to come back down like they have for the last 2 months or so. One thing to remember is that the federal funds rate, and by the Fed's raising rates, that doesn't have a direct impact on mortgage rates. Rather, it's inflation. Mortgage rates are more closely tied to inflation than they are the federal funds rate. So, as inflation settles down or calms down, we will see, mortgage rates improve.
Yeah, I think one of the things, sort of as we're looking into 2023, I think the Fed is probably a little scared at how quickly things could bounce back on the slightest piece of good news. So they've got to, I think they're thinking they've got to do a little bit more pain, as you mentioned, just because I feel the same way. Like we've seen it just recently, that the market is ready to go. It will snap as soon as there's the slightest, light at the end of the tunnel. So, and you mentioned feeling some pain. You mentioned inflation. We're starting to see that come down. How has that impacted? What are you seeing for your clients with home prices? I'm going to assume it's not as competitive as it once was, but I had someone mention to me a few weeks ago, basically, that buyers are acting like it's 2008 and sellers are still acting like it's 2020. And there hasn't been this compromise yet between those two things.
Yeah, I love that. That's the perfect analogy. I mean, the truth is buyers have options now. Buyers have options that they haven't had. Let's forget the last 2 years, because the last 2 years, I think, were a little unrealistic.
Right.
But I think that buyers have more options than they've had in the last 10 years. To be honest, I don't think that it's flipped to being, completely a seller's market, or a buyer's market. Excuse me. I don't think it's flipped being a buyer's market just yet. Inventory levels are still suggesting that it is a bit of a seller's market, but again, we talked about sort of the unrealistic low rates. Sellers still have a little bit of that feeling, right? Oh shoot, I missed the mark
right.
I missed it by 6 months. I missed it by 8 months. But the reality is, during COVID and the low rate boom, houses were selling in, 2 or 3 days. Now the average days on market is just over 30 days, which is really not that long.
Right.
But what we are seeing is we're seeing price negotiations. We're seeing concessions in the form of, sellers paying for closing costs, sellers paying to buy down our buyers' interest rates, and eliminating that multiple offer, sort of that craziness that led to this, really rapid increase in home prices. So, home prices are, I would say, stable. I don't think that I've seen home prices come down. Appraisal values that we're seeing are still coming in value. However, I think that homes are being priced accordingly. So, something that I like to mention to my clients is, just because you see a realtor dropping the price of a home, that doesn't mean that home prices are dropping. It means that the house is being priced accordingly. Real estate values are still continuing to appreciate despite, what's going on in the interest rate market. The houses being listed for sale is not always the best, indicator of home value or appreciation.
Yeah, I think that's fair. It definitely, because, the realtor can put a price on the home at whatever they want, right? They can, whatever number they think they can try to get, I guess. So it may not necessarily, to your point, reflect the fact that prices are coming down, just that one particular home, they did a bad job on the front end. So given that rapid increase, and I think it's funny enough, we're doing this 6 months later than I did the last time. And I think even then we were having this, well, did we miss it? If I missed it, what do I do type of conversation. And that was still probably 2.5% ago, right? So if you missed it then, you certainly feel like you missed it even more now. But from the outside looking in, it feels like mortgage companies are feeling the pain, so to speak, a little bit, and have gotten a lot more creative in what they're offering than what they were even 6 months ago. 6 months ago, it seemed like everything was just holding steady. We'll see what happens. But, fast forward to today, it feels like mortgage companies have gotten a lot more aggressive in what they're looking. Well, aggressive is maybe not the right word, because you're still, the underwriting is still going to be strong, but they've got products out there to help clients who feel like, hey, maybe I missed it.
Well, yeah, that's the whole thing is trying to make sure that we can create, a balanced market, right? People have got to sell their homes. People have got to buy a new home, whether that's because they're downsizing or moving to a new location. But, interest rates have a real impact on, what buyers can afford. And, something that we've been doing almost primarily now, and we're taking it back. This is a throwback, but we're bringing it back to the buy downs. And basically, there's a couple different variations. There's a 1-0 buy down, a 2-1 buy down, or even a 3-2-1 buy down. And the way that the buy down works is it's a seller funded buy down of your interest rate, whereas the seller of the property puts a certain amount of money into an escrow account that subsidizes the monthly payment and buys down the interest rate for the prospective buyer for whatever period. So in the scenario of a 2-1 buy down, the interest rate is 2% lower the first year, 1% lower the second year. And on the third year, it goes to whatever the current rates are right now, not on year 3. But, given what we talked about earlier, the fact that we believe that inflation will come down and that there will be a refinance opportunity somewhere on the horizon, we think that this makes a lot of sense. Now we don't have a crystal ball. We can't predict that. So that is something that we make sure and talk about with our clients. We are qualifying them, though, off of the worst case scenario, which was not the case in 2007, 2008, and leading up to that time, right? They were qualifying based on that lowest rate possible or based on that interest only period. So, I think that's something else that's important to talk about is underwriting criteria and underwriting standards are tighter than they've ever been. But, there's a way to do this and to do it correctly to make sure that we're maintaining a balanced housing economy and providing tight underwriting standards for buyers.
I'm glad you mentioned the underwriting piece of it too, because I do think, we're hearing a lot, and there's always people calling for the end of the world in the media, right? But I do get a lot of questions related to, is the housing market going to crash, right? Are we heading back to 2008? That's the last time people really can remember any sort of real estate chaos happening. Obviously the real estate market moves just like any other market up and down, but the people that are buying homes today, and you can back me up on this, are just in such a better position than they were then, that the risk of that, now prices may come down, but dropping 20-30%, I think is not realistic at this point.
Yeah, I mean, I see prices, depending on your market, of course, I think prices will change, but yeah, I don't see a 20-30% decrease in prices. There's simply too much demand for our current supply levels. And that's something else that, the media and a lot of people aren't looking at is housing starts versus current inventory, right? Nationally, I think there's something like 1.6 million housing starts, and there's only 1.3 million housing units, of which 100,000 are dirt that you can't live in, you can't move into, or, homes that are lost to fire or natural disaster or something else. So really that number is more like 1.2 million. So, we're still not making up for the need that we have in housing. Plus, homeowners today, I just saw some crazy statistic. I mean, we have more equity in our homes than we've ever had, ever, and a lot of that is due to, what's happened the last couple of years, but also foreclosures are at the lowest point, or near record lows as well. So, the average homeowner these days has more equity, can sell their home quick, and we're just not seeing that foreclosure number, the needle really move much at all.
I want to go back real quick too, because I think I unintentionally cut the, where we think the market going, where it's going short a little. You and I talked sort of before we got on this, as you're talking about those buy down programs and the refinancing, right? That's the reason you do that, is the hope that rates come down in the future. And I think market expectations, at least with what the Fed is doing, and again, as you mentioned, Fed and mortgage is not directly correlated. They're just sort of in the same world, right? They move sort of in the same directions here. Market expectations, I think, is that rates don't really start coming down again until maybe the fourth quarter of 2023 into early 2024. Is that it sounds like maybe those products that you mentioned are set up that way, given that sort of 1 to 2 year time frame when it may make sense to be able to refinance.
Yeah, I mean, I think our expectations are, 12 to 24 months. There's going to be, certainly some positive, movement with inflation, meaning that, inflation will come down, and that will have an impact on rates. But, as I mentioned early on, is, last year we had a little bit of a sneak peek into that window, and kind of how the markets are going to react to that positive news. So, we're in a hard position, and the last person I'd want to be right now is Jerome Powell, and having to make these decisions because, inflation is real, and everybody's seeing it and everybody's feeling it. But on the flip side, unemployment is super, super low. We're not seeing, we're really not seeing that rise up. As a matter of fact, the latest unemployment numbers, I'll say, correct me if I'm wrong, I mean, I think they came in even better or worse than expected, depending on how you're looking at it. There were even more jobs created than what was anticipated.
Yeah.
So
that's been a really interesting thing to track, because that, that's what the Fed's trying to do, basically, to help inflation, is drive unemployment, right? So
yeah,
and they can't do it for whatever reason.
So, that's certainly something to watch, but I just, I think that over the next 12 to 18 months, we are going to see, rates come back down into this more normal range. And by normal, I'm personally, don't quote me on this. I'd love
this
to
is
see...
recorded, so someone's going to quote you right now. I'm just kidding.
I think a healthy market is 5 to 5.5%. And I would love to see rates come back and settle into a 5.5% range. That's in a perfect world, that's what I would like to see.
Yeah, hopefully we can set sort of an equilibrium level there. So
and I think that's it. I think it creates equilibrium on both sides, for buyers and for sellers. And of course, the real estate market, the mortgage market, just like, your markets, they're cyclical. There are ups and there are downs, and we're in a cycle right now. But if we zoom out a little bit, we can see that real estate is a constant. And like you said, the 2008 and 2009, Great Recession, is still fresh in a lot of people's minds, because that was the most recent major recession. But if we go even further back and we look at these other times of recession, home prices have actually continued to increase. And the other thing that typically happens during a recession is rates improve. So I think the last recession was caused by, a lot of bad lending and, false demand for some housing, and we just don't have that same issue right now.
Yeah, that maybe that's the best place to end, because I do see, given all this, there's certainly recession concerns as well, which to your point helps rates, but housing still is still a good place to be, right? It's still a good asset to have. And as you mentioned, just with where equity is and things, there's definitely a bigger buffer today than there was then. And, it's certainly going to be interesting to track over the next year as well.
Yeah. I really like this market. I'm excited to see what's going to happen next year. I think if you're a buyer or a seller right now, there's a lot of opportunity on both sides of the table, for sure.
All right. Well, thanks for coming on, Nikko. Appreciate it. If you have any questions or would like to learn more, please check out our website at wittenbergwealth.com, or you can text me at 801-839-7056. Please remember to subscribe to the Wealth of Insight podcast and share with your friends and family.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Whittenburg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Whittenburg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.